Continuation part of 10 economic indicators along with detailed explanations on each, along with guidance on collecting and utilizing the data. Art. Consumer Price Index, CPI, a measure that examines the average change in prices paid by consumers for goods and services over time. National statistical agencies regularly release CPI data. Websites like the Bureau of Labor Statistics, BLS, provide CPI information. Utilization. CPI is a key indicator of inflation and is used to adjust wages and pensions. No. Trade balance, the difference between a country's exports and imports of goods. National statistical agencies provide trade balance data regularly. Central bank reports and international trade organizations publish this information. Utilization. A positive trade balance, exports greater than imports, contributes to economic growth, while a negative balance may pose challenges. Thus, Consumer Confidence Index, a measure of consumers' optimism or pessimism about the state of the economy. Private research firms and consumer agencies conduct surveys to compile consumer confidence data. Reports are published on their websites and financial news outlets. Utilization. Consumer confidence can impact spending patterns, making it a leading indicator of economic health. 11. Housing starts, the number of new residential construction projects that have begun during a specific period. Housing starts data is often released by national statistical agencies. Housing and urban development departments may publish this information. Utilization. A rising number of housing starts indicates economic growth, as it reflects increased construction activity. 12. Leading economic indicators, LE, a composite index that aims to predict future movements in the economy. LE is compiled by private research firms and economic research organizations. Websites like the Conference Board provide LE data. Utilization. LE helps anticipate economic trends and provides insights into the direction of the economy. How to utilize economic indicators for better results. Create a dashboard. Compile key economic indicators into a dashboard for easy monitoring and analysis. Set baselines and targets. Establish baseline values for each indicator and set target levels. Deviations from these baselines can signal economic shifts. Correlation analysis. Analyze correlations between different indicators and their historical relationships with stock market movements. Compare with market expectations. Compare actual economic indicator data with market expectations. Surprises can lead to market reactions. Consider lagging and leading indicators. Understand the timing of indicators. Leading indicators provide insights into future trends, while lagging indicators confirm trends. Incorporate qualitative factors. Consider qualitative factors like geopolitical events and policy changes, as they can influence market dynamics. Stay informed. Regularly update your economic data and stay informed about global economic conditions and trends. Diversify information sources. Utilize various sources for economic data, including government reports, central bank statements, and reputable financial news outlets. Apply scenario analysis. Consider different economic scenarios and their potential impact on your investments. Consult experts. Seek insights from economic analysts, financial advisors, and experts to gain a more comprehensive understanding. Remember that economic indicators are part of a larger economic landscape, and their interpretation should be done in conjunction with other factors. A holistic approach to economic analysis, considering both quantitative and qualitative aspects, is crucial for making well-informed decisions in the financial markets. Subscribe to our channel for more updates.